Welcome back to another video. In this one, we'll be talking about index funds and why you, yes, you who are watching this video, can do better for yourself. I realize that that's a very provocative statement, so let me add some context to that statement. For those who don't recognize this image, this is Jack Bogle, the founder of Vanguard. He's the one that popularized index funds a long time ago. So the first thing I want to add is that index is the far superior method of investing for most people. Even Warren Buffett, who's arguably the best stock picker of all time, has said this.
The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies for the S&P 500, and to do it consistently, and to do it in a very, very low cost way. If you are buying an index fund, you are protecting yourself against the fact that you don't know the answers to those questions, but you think you can do well over time without knowing the answers to those questions, as long as you consciously recognize that fact. And I would, if you're a young person and you intend to save a portion of your income over time, I just say just pick out a very broad index, and I would probably use the S&P 500, because I think if you start getting beyond that, you starting to think you should be in small caps this time and large caps that time, or this foreign side. And as soon as you do that, you're in a game you don't know. You're not equipped to play. In all candor, that would be my recommendation. Charlie.
When you hear this man saying that picking stocks is not right for the majority of people, and that if you're a young person and just starting out, the best thing to do is just dollar cost average into an index fund, it can be quite discouraging. It's normal to feel discouraged to pick stocks at this point. But the key thing to note in all of these statements is that index is the far superior method of investing for most people. Emphasis on the most. So join me in this video where I'll be going over the pros and the cons of passive investing, and then I'll be going over the pros and cons of stock picking. Hopefully, at the end of this one, you should have a pretty good idea of which one is a better fit for you. You won't believe it when I say that one of the biggest advantages of index fund investing, aka passive investing, is that it's passive. It's one of the only forms of investing where you can do well for yourself with very minimal effort. Have you ever dreamed of sitting down on the beach in white sand with your partner, closing your eyes, all while your portfolio is rolling in the back, bringing in the dividends, bringing on the capital gains? And you don't even have to log into your brokerage account. All you have to do is dollar cost average every month when the paycheck comes in. So I would say that in terms of effort for money, there's nothing on the market right now that beats index fund investing. So this is obviously a huge pro for someone that doesn't have a lot of knowledge about finances and the stock market, and especially for people that have no interest to learn at all. The next big pro about index investing is diversification. I mean, the whole point of buying an index fund is that you don't pick the needle, you don't have to. You just buy the whole stack. Index funds will usually mirror the entire market of a country or a region or even the entire world. And if you know anything about investing, you'll know that diversification is one of the key tenets of any good investor. Putting all your eggs into one basket is just way too risky. And so the theory goes that if you invest in a lot of different companies, then you remove a lot of the risk from making any mistakes. And here's the thing, there is such a thing as over diversification. Peter Lynch, who's one of the most famous investors in the world, has coined the term diversification. Now, initially, he meant that for companies where management tries to diversify the business operations. And so they go on an acquiring rampage and they buy this company and this company. And what he says is that there is such a thing as being too diversified. And usually when management has an idea of, acquiring another company for the sake of diversification, it ends up making the original business worse. And this concept can also be applied to individuals and to your own portfolio. There's no way that your best idea of investing is as good as your 25th best idea. Dare I say, your 100th best idea. Even the king himself, Warren Buffett, has had a few words to say on this subject.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market. You own everything. There's nothing wrong with that. I mean, that's a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number one just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. But three wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and three of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning three easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that.
So let me be honest. I'm not saying that everyone should have three stocks in their portfolio. Ideally, yes, but that wouldn't work for the vast majority of people. But in the video we just watched, Warren Buffett is badmouthing having 50 companies in your portfolio. I just want to show how many stocks are in a typical index fund. So SPDR's S&P 500 ETF Trust under the ticker symbol SPY, very common index fund. It mirrors the S&P 500 and it holds the 500 biggest stocks in the US market. So that's 500 companies you're splitting your money into when you invest even just $100 into this index fund. What about the MSCI World Index? This one covers the entire world. Well, there are 1,456 individual stocks in this index. So for every $100 that you put in this index fund, you're splitting your money into 1.4K companies. But wait, it gets worse. This is VTI, or Vanguard Total Stock Market Index Fund. Technically, this one is supposed to cover the entire US market, so not just the 500 biggest companies like SPY, but the entire market. This index fund contains a mind-boggling 3,674 stocks. So once again, when you're putting $100 into this index fund, when you're dollar cost averaging every month, you're splitting that money between 3.6K companies. So let's take VTI, for example. The largest holding in that index is Microsoft. If you ask any investor in the world where Microsoft stands in the ranking of the best companies in the world, if you could own any company in the world, which one would it be? I'm sure Microsoft would be on their top 10 list every single time. Microsoft is an incredible company, and if you can buy it for the right price, it can be the investment of a lifetime. So I guess good thing that VTI has this holding. But that same index fund also holds a company called Tupperware, the company that makes these famous containers in plastic. And clearly, this company is famous, it has a very well-known brand, but this company is nowhere near the same quality as a Microsoft. And yes, if you bought VTI in 1996, you would have also owned this stock all this time. Now, I can hear you coming from a mile away, but they're not all the same weighting. Yes, that's right. Most indexes are market cap weighted. And all this means is that the largest companies by market cap make up most of the index, while the ones that have a very small market cap make a very minimal part of that index. But what people often forget is that large companies by market cap does not mean that the company has a very high income or that the company generates a lot of cash. Yes, the market cap is a function of cash flows, but it is in large part also a function of investor sentiment. And so at the moment, if you're investing in the S&P 500 or SPY, as you can tell from this chart, 33% of your money is going into big tech. And as we know, big tech has performed really well over the past decade and really well over the past 2 years and the past year. And big tech has also been a huge beneficiary of the AI wave, whether that be cloud providers like Microsoft or Google, but also chip manufacturers like Nvidia or Broadcom. And if you look at the free cash flow multiple on these companies, they're all pretty high. This gentleman right here, his name is Benjamin Graham. You might recognize him. He's the author of The Intelligent Investor, and he's the mentor of Warren Buffett. One of his greatest contributions to the world of investing is the invention of this character called Mr. Market. Mr. Market is a manic depressive. One of the first lessons you learn as an investor is to use the market in your favor. Well, I can tell you that when you invest in an index fund, you're playing to the market's mania or depression. What I mean by that is when stocks are bid up really, really high, that's when you're going to allocate the most to those stocks. And when stocks are out of favor, that's when your money is not going to go to those stocks. So, in a sense, yes, when you dollar cost average every month, your portfolio will grow in line with the market. But if you take a closer look, what you're really doing is you're buying high because the companies that get bid up the most are the ones that get the most of your money. So on our chart here, I'm just gonna go ahead and add diversification and buying high to the list of cons when buying an index fund. The next pro on the index fund list is that the maintenance is pretty much done for you. Every quarter, the S&P 500 is rebalanced, which means that some companies get eliminated from it and some companies get added to it. And there are specific criteria for a company to make it to this list of S&P 500. Here's the full list of criteria that a company needs to maintain in order to be included in the S&P 500. The company has to be from the US. The market cap must be at least 8.2 billion. The shares must be liquid, aka they must be highly tradable. At least 50% of the outstanding shares must be available for public trading. It must report positive earnings in the most recent quarter, and the sum of its earnings in the previous 4 quarters must be positive. So let's summarize that. It's an American company that's large enough, that's highly traded, and that's shown profitability in the short term. If that sounds like low standards, trust your instincts. Just to give you an example, all three of these companies, Southwest, American, and Delta, are all included in the S&P 500. It's a well-known fact that airlines don't make a lot of money over the long term. As a matter of fact, most of them go into bankruptcy or end up losing their shareholders a lot of money. But because they're large enough and because they've been profitable over the last year and over the last quarter, even if that's just a little bit, they're included in the 500 largest companies. So I just need to do it, and I'm gonna add low standards to the cons of investing in index funds. Because just with a little knowledge and a little bit of work, it's possible to eliminate some bad names from this index. So if you can do it, why not? So the fourth point here in the pros of investing in index fund is that the market only goes up. One of the main arguments from people that are proponents of investing in index funds is that the market has never gone down over a 20-year period. And that's a nice thing to tell yourself that no matter what happens, if you wait long enough, you will never lose money. Over time, economies grow. And so, if you're betting on a country's economy, especially one like the United States that has a very strong economy, then you'll do all right for yourself over the long term. Now, just as a parenthesis, imagine that inflation was 3% over those 20 years. If you had matched inflation, you would have had a 80% return over those 20 years. But let's get back on topic. This is the price chart of the S&P 500 over time. And yeah, the trend is beautiful. It's up and to the right. But even in a strong economy like in the United States, there are periods of time, and I would say pretty extended periods of time, where the market really goes nowhere. And that was the case from 2000 to 2012. So all the money that you invested in 2000 in your monthly dollar cost average would have gone nowhere for 12 years. If you consider inflation, that's actually a pretty big loss. But this statistic of never losing money over 20 years only really applies to the United States. Because if we look at other markets, take Hong Kong for example, this one is still not past its peak from 2007, and the chart is just not as pretty as the S&P 500s. If this were to happen to the S&P 500, you bet that a lot of these index fund investors would not be buying into it every single month. That's very hard to do when the market is down. And once again, here's the Japanese Nikkei 225. This market experienced a huge bubble in 1989, and only this year did the price catch up to where it was back then. That's an astounding 35 years without gains for the money that was invested at this point. Now, you're just going to say, oh, but you're cherry picking all of these indexes that haven't done well for extended periods of time. Yes, I agree. I'm cherry picking. But this is just to provide examples that indexes don't always go up all the time. And you can lose quite a lot of money by mistiming a purchase. So, what I'm trying to say here is that if you're in the US, yes, the market only goes up over extended periods of time. Over 20 years, you'll always be in the positive, nominally. But not everyone has time to wait 20 years. And so the price you pay when you just dollar cost average without taking account of anything going on in the market can be quite severe. Before we move forward and we go over the pros and cons of picking individual stocks, I want to go over these two particular points. Now, these 2 points are often used as arguments from passive investors that say that picking individual stocks is really futile. The first point is that retail investors don't beat the market and that even the professionals can't beat the market. This point has a lot of merit. If we look at for the past 20 years, the returns of the S&P 500, it's normally about 9.5% annualized. If we compare that to the average investor has only returned 3.6% every year for the past 20 years. Now, there's a whole lot of reasons why average investors don't do well in the stock market. A lot of people treat the stock market like a casino. They do short term trading, they do bad strategies, they buy high, they sell low. They get psychological, and so they get excited when the market goes up and they get scared when the market goes down. They try to time the market. And overall, I would say that the average investor lacks education necessary to do well in the stock market. The real mind boggling statistic is that even professional investors don't beat the market. And as we can see here, about 90% of professional funds don't beat the market over a 15-year period. So when you impress this statistic on someone, of course they're going to be discouraged to invest by themselves in the stock market. If the pros can't do it, why should they? And they're absolutely right. For the average investor, it definitely makes no sense to invest by yourself in the stock market, but it also makes no sense to give your money to an active fund manager. And I would say in the vast majority of cases, index funds are the way to go. But if you're watching this video right now, it means that you probably have an interest in stock markets and you're interested in educating yourself and knowing more about it. And so in a very specific subgroup of retail investors like you and me, there's a few reasons why this statistic is misleading. And the main reason is that professionals have career risk. If you're a professional investor, what's even more important than long-term returns is assets under management. Your job incentivizes you to maximize the amount of assets that you manage because those are the fees. That's how you make your fees. That's how you win your bread. Long-term returns are secondary because in the end, what attracts people to your fund? It's short-term results. People see that a fund has done really, really well over the past year, and they're more likely to put their money into that fund. Just like they do when they invest for themselves, retail investors chase returns. And so if a fund is doing well over the short term, they'll invest. And if it does poorly compared to their peers, then they'll take the money out and invest somewhere else. So as a professional fund manager, you're incentivized to perform well this year or this quarter, meaning you're probably going to take unnecessary risks and optimize for right now rather than the long term. That's the first thing. The second thing is that your name can really be tarnished if you're the only one in the industry that performs poorly in a given year. That's even worse if you perform poorly over 5 years, 10 years. So take a professional investor that's a deep value investor. They've probably done super poorly over the past 10 years. I would be surprised if that person has kept their job throughout this time. Because if a strategy is not performing right now, that fund is not going to be kept open indefinitely. And so, as a professional fund manager, for your career, it makes more sense to be average, to follow the S&P as closely as you can because everyone else is doing that. If the market drops 40% in a year and you drop with it, so what? You can blame it on the market. But if you drop 40% while the market is up 40%, that's it. Goodbye. You're done. When you look at fund managers that have done very well over the long term, they're not doing anything special. They just have clients that are very long term focused. And they have a culture where they educate the clients and where everyone is on the same boat that this is for the long term. It doesn't happen often because a lot of people are impatient. But I think that's enough to disprove that even the pros can beat the market. Because yes, they don't beat the market, but that's because they're not playing the same game that you and I would be. The second statement that's always brought up is that 4% of stocks are responsible for 100% of all stock market returns. And so, if that's the case, what are the odds that you pick one of those 4%? And here I want to give credit to Morningstar that wrote a super article on this. So, this guy, Hendrik Bessembinder, published the original study on the stock market performance of 26,000 US companies from 1926 to 2016. And here are the results. The top 90 firms, or one third of 1%, account for half of the shareholder wealth enhancement since 1926. The top 4% of firms account for all of the net shareholder wealth creation since 1926. And if we look at the global results, it's even more scary than just looking at the US. The top 5 firms, which is 0.008%, account for 10% of all returns. And the top 1,526 firms, which is 2.3%, accounted for 100% of returns. And as Morningstar summarizes perfectly, there are two opposing ways to interpret these results. The first view is that if so few stocks create all of the market's gains, it must be extremely difficult to identify them early enough, which speaks to the merit of passive investing and owning everything. The second view is that there are extraordinary rewards for the active fund managers who invest in these moonshots at almost any time in their early development. It does not need to be at pre-IPO, IPO, or shortly after. The author of this research paper acknowledges that the majority of people do not have special skills to identify a few great companies, and he supports the majority holding cheap index funds. However, some investors have enough of a comparative skill advantage, and this might be individuals or fund managers, to select stocks and build their own portfolios to outperform. In this asset class, most investments lose money. Most common outcomes lose all your money. There's a few really big winners that make the whole asset class worthwhile. The textbooks lay out all the reasons why people should have broadly diversified, low cost portfolios, and my study backs that up. Just picking stocks at random, the odds are worse than 50-50. On the other hand, if you can pick those winners of all the games in the future, some investors should be actively trading. The irony is that when people read my study, it's like a Rothschild test. What do you see here? All I can say is there's actually some ammunition here for both sides. So clearly, it's not that black or white. Yes, 4% of firms account for 100% of the market's total returns. If you're a new investor and you don't know what you're doing, this should deter you from simply investing on something just because it went down or just because it went up. As he says in the article, if you're flipping a coin and it's a 50-50 chance, you're probably going to lose. But I think that with a minimum of effort and education, it's possible to identify some of the companies that are in this top 4%. We mentioned earlier the difference between Microsoft and Tupperware. I don't have to be a genius to tell you that Microsoft, with the quality of that company, is probably in the top 4% of firms, and that Tupperware isn't. Now, if that means that I can select Microsoft to potentially add to my portfolio at the right price, and I can avoid Tupperware, then I've already done most of the work. So I think point number two here, while it does discourage new investors of picking stocks, I think it does so for a good reason. I think most new investors and most investors in general would be better off investing in passive index funds. That's what I've been saying this entire video. But I think that some people, especially people that know what they're doing, will be better off by picking individual stocks. At the end of the day, if you take an index like the S&P 500 and you can identify 5 companies that will probably be in that 4% and eliminate 10 that will probably be in the other 96%, you've already done some really good work and your returns would be better than someone that just bought the entire index. Great. So now we can move on to picking stocks, pros and cons. And let me be clear. When I say picking stocks, I don't mean trading. I don't mean buying an asset and then only to resell it a few months later. What I mean is creating your own diversified index fund over time. The first pro is that you can be selective. When you actually think about businesses, you can separate the ones that look like they're good companies from the one that look like they're bad companies. Now, that's not sufficient to get good returns because you also have to consider the price. But even if you're wrong on the price of a great company, you might be down for the first few years if the market corrects, but over time, you won't lose that much of your money. Whereas it takes a lot more skill to buy a not so good asset for a great price and then be able to sell it at the right time. Don't get me wrong, you can still make money that way. It's just a lot harder, and that's not something I recommend. A lot of people say that investing in the entire stock market reduces risk. I think it's the opposite. Like I said earlier, I think that by eliminating some really bad assets and keeping the really good ones, you can diminish your risk a lot. The second point here under pros of picking stocks is the enhanced control. Let's be honest, at some points in your life, you're gonna have to sell some stocks. There's a million reasons why that would happen. It's best not to do it. But if you have to do it, then having control to pick which stocks to sell is always going to be better than selling part of your index fund. Now, why is that? If you have a portfolio of individual stocks, odds are you're going to be able to tell which ones are a little bit overextended at the moment, which means they're quite expensive, and which ones are very cheap. Now, that's not always easy to do, but you can probably have an idea of which ones are in the top 50% and which ones are in the bottom 50%. And that means you can be also more selective when you're selling assets. Because if all of a sudden you have an emergency and you have to sell stock, you can decide which individual companies to let go. And at that point, it'll be a lot more advantageous for your long term compounding to let go of stocks that are quite expensive at the moment. The other thing is the opposite side of the transaction when you're buying every month. If you can pick which companies are very good companies, and out of those good companies, which ones are selling probably at a good deal, you can direct your capital towards those assets. At the end of the day, if you hear a lot of the great investors, they'll say that they find 2 to 3 deals in the stock market every year. If you're able to invest in those stocks that are good deals for a whole year, you probably won't be diversified at the start. But if you do that over and over for decades, over time, you'll end up with a portfolio of large positions and it'll be still well diversified. So when you're picking stocks, you have control of what you're buying, when you're buying, what you're selling, when you're selling, and it's just a lot easier psychologically. Say you're in a downturn, it's much easier to hold on to your stocks when you know exactly why you've bought them and why you shouldn't let go of them. If you're investing in an index fund, now you're trying to time the market if you're trying to sell and buy at specific points of time, and that's never a good idea. And speaking of diversification, I just want to emphasize that 20 stocks, 30 stocks, that's the maximum amount you need to get fully diversified. There's been many studies to show that beyond that, you don't get a lot more diversification. So, yeah, you don't need to invest in VTI and have 3,000 stocks to be properly diversified. 20 to 30 stocks will do it. The last point here under the pros of picking stocks is that nobody knows you better than yourself. And because of that, you're able to allocate your capital in ways that are best fit to your person. Do you like passive income? Well, you can invest in stocks that pay dividends. Do you want to max out total shareholder return? Well, maybe you want to max out free cash flow growth. Maybe you're interested in certain geographies and you think that Great Britain is a good place to park some money right now. Or maybe you think that oil is undervalued and so you might want to find some quality companies in oil. Maybe you're going for maximum capital preservation and you're trying to prioritize safety. Or maybe you want to avoid certain sectors for ethical reasons. Maybe you're trying to mix and match a bit of everything. If you invest in an index fund, you're buying the whole stack. Only by picking stocks are you able to cater to your very own preferences. So, moving on to the cons, there's really only one con to picking stocks, and that's not risk. We've already been over that just identifying a few great companies and separating them from a few mediocre companies can make your returns better with less risk. Just blindly buying the whole stack doesn't make your risk lesser. The real con is just time. The reality is that picking stocks well takes time and effort, and there's really no way of getting around this. You have to put in the time to learn about business, learn about what makes a good business. You have to learn how to value a business and all that. But luckily for you, there is one solution, and that's called Rated A. I look at stocks all day to be able to separate the great companies from the mediocre ones. That's where the quality rating comes in. The value rating tells you which stocks might be a good deal at that very moment if you want to maximize total shareholder returns. And the income rating is more meant for investors that want to maximize income that's safe and growing over time. But all you need are these three ratings to know what to buy and when to buy. With Rated A, you can have it all. You can have all the pros of picking stocks without all the cons. Alright, it's a pretty long video, so I'll end it here. Thanks for watching, and I'll see you in the next one.